If you're not using the payment processing triangle, you're leaving tons of money on the table. There are 3 things that make up this triangle when considering a payment processor. These 3 things will affect your ability to process all the cards that exist in the world and create more revenue in your business. The first being the most obvious, the percentage. What are you paying in fees? Even if a site like Stripe tells you they're at 2.9% plus 30 cents, it could actually be a lot more. You really don't know until you give your statements to a professional. 3 months of processing statements is all my team needs to understand what you're paying and for what cards, and it varies in every country. The next one most people do not talk about is card authorization rates. I didn't even know about this until like last year. And it didn't become a big issue until recently, because when you have cards processed as a business owner, not all of them go through even if they have the money, which is wild to think about. The cards just don't trust you, the processor. It could be your fault sometimes. Oftentimes, though, it's because if you get set up with a Stripe or a Shopify, they will bucket you into a what's called MCC code, which is pretty nasty for your authorization rate. They'll tell you that because your business type, they're going to not honor the transaction. It's just going to go to the more risky algorithm. And when the algorithm thinks you're too risky, they're not going to let a transaction go through. Stripe, as far as we know, 75% is their card authorization rate across the US. For the processor I work with, can be about 91%. You want to get a higher rate because if you're running low ticket, especially recurring, that will affect your ability to collect cash from people who wanted to pay you money. Pretty sad story. They wanted to pay you money. It just didn't happen because there was a mean banker in the middle who didn't create that relationship. So the next one is a financing tool. When you have a financing tool, like a buy now, pay later, you make more money. Because your sales reps, or if you're doing an automated checkout, your checkout process allow your customers to pay you even if they don't have the money right now. And so you want to check and make sure that the BNPLs relevant to your industry are there. If you have an offer that only goes up to $1,500 or $2,000, you shouldn't really care about having Klarna. Klarna, as an example, will approve you up to $10,000. It's just that it's really hard to get approved these days. It's not the same as it was back in my day, 2020, 2021, when you could get people approved for just about anything. Sound like an old man saying that. But you want to make sure that your BNPLs are relevant to the products that you're selling. And that if your demographic, your average credit score on your demographic is, say, like 620, chances are they're not going to qualify for a Klarna, but they could qualify for a ZipPay. And so you should care about the ZipPay. Likewise, if you're selling to an affluent audience, like one of my clients is a stock market educator, they're selling to affluent clients. They got people who are, multimillionaire investors buying their products. You would think, they don't need BNPL. Well, no, they actually value it big time. They just don't need ZipPay or Klarna. They want solutions like SplitIt. SplitIt is you've heard me talk about this before maybe, card-linked installments. You take somebody's card with an existing credit line, say 10 grand is on there, and instead of you swiping it, charging it all at once, imagine I'm on the phone with you, hey, client, future client, instead of you getting charged right now, it's going to do an authorization hold similar to a hotel. And only payments spread out over 12 months will be taken from your credit card. So it's not going to be swiped and used all at once. We're simply putting an authorization hold, and then over the next 12 months, in the form of monthly payments, you will pay using that credit card, which means you don't carry a balance. If this is an interest, if there's not like a 0% interest credit card they're using, it's a big deal because they don't got to worry about the interest. And it makes it a no-brainer, and it makes sales go up. Cool thing about this, it's available with the processing team that we work with. So processing rates, I can get you at 2.7 or below, depending on your volume. Authorization rates can get you up to 91%. And I hear that in Europe, it's even higher these days with the processing team we got. And for the financing options, we can get you ones that suit your target market. Because maybe you don't want SplitIt. Maybe it's useless to who you're selling to. But you got to be aware of that. You got to know what the terms of each of these are. What they're most likely to approve people by. to up to what specific amounts they'll approve them on. And with those three things, you will master payment processing. I just explained it to you, so you're technically a master now. And if you're interested in having a conversation because you're getting shafted by your current payment processing partner loosely, contact me, send me a DM. We can have a conversation fully, and I hope you sort all these things out. Hope you enjoyed the video. Talk to you soon.